Welcome to the Frostrow Investment Seminar pre-recording for the Chikara Japan Income and Growth Trust. So my name is Theo Wyld. I'm a portfolio manager and analyst here at Chikara. And who are we? Well, we are a boutique investment manager based in London, and we focus on Indian and Japanese markets. These are geographies where we believe wholeheartedly that there are rewards for active investing. And these strategies are specifically developed to take advantage of their local markets. So a very quick intro to the team. The three of us are all based in London, but each of us travel regularly to Japan to spend multiple weeks a year visiting companies and building a local network out in Japan. Richard, the lead manager, he has been covering Japan since 1997 and launched the strategy first in an open-ended vehicle in 2013 and then the trust in 2015. So coming up to 10 years of track record on the strategy. So a little bit of background. The chart here shows the topics total return, so the Japanese market total return since the late 80s. And as you can see, for a couple of decades, Japan was a very difficult place to invest, specifically or especially if you were looking to buy and hold as the market was trending down post-bubble. You needed to be efficient in trading to catch short-term rallies and subsequently to time your exits to avoid the almost inevitable market falls that followed. However, we're here today to tell you that things changed and Japan is very much an investable universe and very much one that you can buy and hold. These changes began in the 2000s, and then you can see with the red dotted lines marked on the chart above, that the strategy was launched nearly 10 years ago to take advantage of the changes that I will come on to. I'm well aware that the experience of the 80s and 90s has scarred many investors, both domestic and foreign, and perhaps that has caused them to spend less time looking at Japan subsequently, and I'd like to make the case for Japan going forward. So what changed? Well, these are the three things that we believe turn Japan into a much more investable universe, and they are our core investment principles today: cash flow, valuation, and governance. I'll come into these each in turn, but the first sort of changes began in the early 2000s, and then the final piece of the puzzle fell into place in around 2012, 2013, which was, in our case, governance. And the confluence of these three factors led to the launch of the strategy to take advantage of the opportunity that the team saw in Japan. So firstly, cash flow. The left-hand chart shows capital invested, which is the light blue line of Japan Inc. or corporate Japan. And the dark blue line is cash flow generated by the companies. And as you can see, post the World War II, the so-called economic miracle of Japan was driven by a need to reinvest all the cash flow generated for growth. And you can see that by, for the first couple of decades, the two light blue line and the dark blue line track each other very, very carefully up until the bursting of the bubble around sort of late 80s, early 90s. That was the catalyst for change. And in the late 90s, Japan began its long process of deleveraging, of writing down assets that had been bid up during the bubble and repairing balance sheets. You can see that the cash generation, the dark line, has continued to pull away from the cash invested, which is the light blue line. And it is this divergence that caught the attention of the team back in the 2000s. It was a better allocation of cash flow, i.e. in terms of the investing discipline, but also coupled with the better cash generation, which came through running the operations leaner and better, generally improving cash flow generation. So you can see the trust inception spread is marked there in 2015, and you can see today that the spread is as wide as it's been, and we think that is indicative of the opportunity that exists in Japan today in terms of cash flow generation has never been stronger, and capital investment has never been more disciplined, in our opinion. And the right-hand chart shows one of the key beneficiaries of this spread widening, which is allocation to shareholder returns. So not only is the investment becoming more disciplined in our view, shareholders are benefiting by being returned surplus cash flow, both in the form of dividends and buybacks. And this is a core component to our total return strategy here at Chikara, which focuses on both growth and income. You would be forgiven for looking at the right-hand chart and thinking perhaps the best has already happened. The momentum has been extraordinary, as you can see. However, we would say there is plenty more to come on this. Not only do more than 50% of Japanese companies have net cash on their balance sheet, but also their dividend payout ratios remain below that of other developed peers. So there is much more room for improved shareholder returns, both through dividend growth and through further buybacks. So moving on to the second of the investment principles, valuation. The chart here shows in light blue the 12-month forward price earnings ratio for the TOPIX, the Japan index, and the darker line is the MSCI All World Index. Now, prior to even the beginning of this chart, Japan traded for decades at a huge premium to other developed markets, making investing much more precarious given there was no valuation cushion. However, in around 2012, 2013, the premium had unwound and Japan had reached parity, so finally becoming a market that was investable on a valuation basis relative to other developed markets. And this coincided, as we know, with the launch of the trust. However, if you look at the current spread today, which is marked with the red arrow, you can see that this is the widest or close to the widest that Japan has traded at a discount to the rest of or the All World Index. So the strong performance of the market that we saw on the previous slide has been driven entirely by earnings growth in Japan. It is no more expensive today, and in fact, it is cheaper than the launch of the trust, both on an absolute basis and when compared to other developed markets. So to buy today, you're buying on a similar multiple, if not a better one, but you're also buying, in our view, better companies, given the return on equity of the market has moved since 2013 from 6% to today's 9%, and we have every confidence that will continue to trend upwards. And you're also buying it on a relative basis at the widest discount since launch. Now, the third piece of the puzzle, governance. This is an abbreviated diagram of the most important changes that have happened since it was all kicked off really by former Lady Prime Minister Abe coming to power in 2012, 2013. The purpose of the slide is mainly to highlight how coordinated an effort this has been throughout Japan to improve corporate governance. So I would say there are three main bodies leading the charge. The first is METI, or the Ministry of Economy, Trade and Industry, which commissioned the Ito report back in 2013, which really kicked things off. Next came the FSA, or the Financial Services Authority, who announced the introduction of the Stewardship Code and Corporate Governance Code, which was actually modelled on what we have here in the UK. And this created a vastly improved environment for investors and corporate managers to communicate with one another. We had many more smaller improvements along the way, But the last major one that I would point to is that of the Tokyo Stock Exchange, or the TSE, and their introduction in 2023 of an initiative to raise the awareness of cost of capital and corporate value. And this was to run alongside of the intention of reducing the number of listed companies in the index to make Japan much more relevant and investable on a global basis. We've seen clear evidence of the improvements driven by these reforms. We've had an acceleration of cross-shareholding unwind, an acceleration in share buybacks, which we saw on a prior slide, and also an acceleration in the number of companies delisting from Japanese exchanges. Momentum is building. The TSE in particular has improved momentum over the last few years in terms of the corporate governance story, but we would also say that there is much more to come here. There are still far too many listed companies in Japan, many of which are run inefficiently. And this is another reason we think being an active manager in Japan is key, given the number of companies that we believe face headwinds, which are included in the index by default. So we have a situation now where, referring back to the last three slides, so cash flow, valuation, and governance, we've got record cash generation, improving cash allocation, better than we had 10 years ago. The valuations are also more attractive, and we believe the governance environment has not only improved, but is also improving at a remarkable rate. So all contribute to our belief that the core principles that we built the strategy around back in 2013 are not only still relevant, but they are actually as relevant as they've ever been. So why the Chikara income and growth strategy in particular? Well, for starters, as I've mentioned, the strategy was developed explicitly for the Japanese market, for the three main investment principles that I've run you through already, but also with the appropriate cultural sensitivities that come with investing somewhere like Japan. Secondly, we are long-term investors, and we genuinely mean that. The average turnover of the fund has been around 20% since inception, the average holding period being around 5 years. We are able to look through short-term noise and take positions in companies that we generally believe can deliver over the long term. And this is not only reflected in the kind of dynamics, the business that we're looking for, but also building relationships with management teams. We are not activists, but we build constructive relationships and become a trusted partner with the companies over time. We think it benefits us, but also companies, where we can become a trusted ally and give a true opinion over time. We go where we see opportunity. We believe in an all-cap approach, especially in a country like Japan, where as soon as you go slightly outside of the large cap space, the sell-side coverage and also the interest from foreign investors is very thin on the ground. So there is a real return on your work for those willing to put in the hours and do the proper bottom-up fundamental research. And increasingly, we are finding the small and mid-cap space increasingly attractive, and you'll see that reflected in some of the weightings over time. We are also benchmark agnostic. We don't have any sector over or underweight requirements, but of course, we are mindful of end market exposure of the portfolio, but this is genuinely a bottom-up driven portfolio. We have over a decade of track record. The team have applied the strategy consistently over that decade, regardless of market conditions. The market has gone through quite dramatic style rotations throughout that time, but that has not changed the application of the strategy, and that is the intention going forward. It is designed to be a core approach that can be relied upon regardless of market noise. And finally, we are not equivalent to a barbell of growth and value. Why am I saying that? The income and growth strategy is not just some income companies balanced with some growth companies. it is a requirement for all of our holdings to have both income and growth attributes. Now, we believe this has two main advantages, one of which being the companies that are paying dividends or buybacks or both. These are companies that are profitable and are delivering surplus cash flow in the majority of times. This prevents the strategy from buying the likes of the companies, for example, small cap, loss-making growth companies, which go through extreme valuation booms and busts, as we saw as recently as 2020. Having an income requirement, and a strict one, precludes us from investing in that sort of company. So we think it's a valuation sense check for starters. And on the other side, the growth requirements, this really helps us to avoid, for the most part, value traps, because we are buying companies that we generally think can grow consistently through time, and we are not buying cheap companies for cheap's sake. So how do we go about finding these kinds of companies? Well, we start with quantitative screening. As you can see, there are nearly 4,000 listed companies in Japan. So we need to whittle that down to a more manageable number of companies exhibiting the attributes that we require, and then to do further work. So once we move out of quantitative, it is the bulk of the work that happens is qualitative. And this is fundamental research, first-party analysis of key components such as business model, strategy, industry outlook, and financials. And we use some robust investment checklists to guide us through part of that process. We also put a lot of evidence, a lot of emphasis on management meetings. These are conducted both in the UK, but also on our frequent trips to Japan. And we believe assessing management quality and also corporate governance standards is absolutely core to what we're trying to do here at Chikara. So we have a wealth of company meetings stretching back to 1997, whose notes we can look back on, and holding management to account, seeing whether or not they deliver on what they claim to be delivering, and assessing their general management skills is a key component of the analysis that we do. Then finally, but no less importantly, is valuation. I've mentioned the income requirements tend to be a first filter on the valuation side of things, but is by no means sufficient. So proprietary modeling, both in terms of sort of cash flow analysis, which we put a large emphasis on, but also in comparing the company to local and international peers. Valuation is key, and we will be patient, as I'll come on to an example, to wait for the right kind of entry point for the company. This culminates in a concentrated portfolio of 30 to 40 positions. So we want each and every one of our investment decisions to affect client outcomes and to keep the number of positions to below 40, such that we can generally outperform. We are, after all, an active manager looking to deliver alpha. So here's an example of a company that recently was added to the portfolio. Hamamatsu Photonics. Photonics is the science of light, and this company is a world leader in this field. It manufactures optical and light devices such as sensors and lasers, and is used in many fields such as manufacturing, to medical imaging, to semiconductor production, and life sciences. It's a company that we've known for many years, and for a long time it was an investment darling, but always traded at high valuations and delivered little by way of shareholder returns, thus being precluded from this investable universe. And looking back, it outperformed the market substantially over the 20 years up to 2023. However, as you can see from the top right chart labeled valuation, which shows The dark line is the next 12 months PE ratio. It went into some difficulties, and we've had a huge derating of the shares since then, and correspondingly a jump in the dividend yield, which is the light blue line. This was driven really by COVID. We had sort of supernormal demand for some of their medical imaging equipment on the one side, and also supply chain constraints, which funneled a lot of demand from their customers to the most valuable suppliers. And by that, I mean, as an example, Hamamatsu has more than 90% market share in a key component which goes into semiconductor manufacturing. So Hamamatsu was one of the first calls that their customers would make to try and secure demand when all supply chains were coming under pressure. So this resulted in a huge over-ordering and over-demand, really, for Hamamatsu's products. But when we came out the other side, the demand failed to keep up with expectations. And we also had some macro considerations where China did not grow as fast as it was expected to, and therefore we had a huge inventory glut in the system, and Hamamatsu suffered from that and is still suffering from that today, a few years later. We are very confident in the underlying structural growth of the end markets for Hamamatsu, and we're confident that the inventory cycle has peaked or troughed, whichever way you look at it, or at least will do so in the near term. And then the market will go back to rating Hamamatsu on the quality of the business and recognize the long-term structural growth drivers rather than focusing on the shorter-term underperformance, which we've seen over the last few years. This has also been coupled with a management change, and their attitudes towards shareholder returns have improved, and they have also improved their shareholder return policy, as you can see inherently in the dividend yield chart top left. So this is a great example of a global leader. Well, these are company attributes that we look for. This is a global leader, i.e. high market shares, strong gross margins, i.e. pricing power. It is financially very sound, large net cash position on the balance sheet, as you can see in the bottom right-hand chart, and with structural growth tailwinds in photonics and applications of photonics. And finally, the attractive valuation. This had been the only thing precluding it from the strategy in the past, but the shorter-term underperformance led to this derating and allowed us to add this to the portfolio. So it's a good example of long-term investors being offered an excellent company if you can look through the short-term noise at bargain prices, in our opinion. The second example of a different ilk is of Zozo. Now, Zozo is Japan's leading online fashion retailer. And the point of this slide is to show that Chikara is not only patient in terms of valuation, but also willing to have constructive engagement with companies over time, even before we become shareholders. So the team met the company 13 times over 10 plus years, but at each time came out with the conclusion that it didn't fit all of the criteria, and that one of the main reasons for that was governance from the founder, who then retired in 2019. You can see on the slide a little bit more information on the concerns that the team had and then the resolutions, but essentially when the founder moved aside in 2019, that removed a lot of the question marks that we had over the governance angle, and it also resulted in an improved shareholder return policy. So the company, we invested in Zozo in October 2022, once it had finally met the investment criteria, including valuation and crucially our concerns over governance. So all of this has culminated in a strong performance over the long term. The light blue line is the total return of the NAV of the trust, And the dark blue line is the share price total return, with the grey line being the Japan market as a whole. And as you can see, there's been more than 50% outperformance if you take the NAV total return versus the topics. And the outperformance has come in both what you'd label as growth markets, i.e. pre-COVID, and also value markets, i.e. post-COVID. A point I made earlier about the consistency of application of approach throughout, regardless of market conditions. I believe this shows the resilience of the strategy and the benefit of holding, buying and holding for the long term in Japan. The strong performance has allowed the board to maintain healthy and growing dividends from the trust. Here's the track record, as you can see, compounding it at almost 8% per annum. And it's important to note that we have not had to rely on distribution of capital to pay the dividend. The dividend has been generated solely from income generated in the underlying holdings, and there is in fact still a small reserve held in the trust today. So what conclusions should we draw from today? Well, firstly, Japan is fundamentally investable. As we started the presentation by showing, this has not always been the case, but changes began 20 years ago and are continuing to bear fruit. Inefficiencies create opportunities for active management. We've mentioned things such as lack of sell-side coverage or interest from foreign investors as being reasons for the inefficiencies in the Japanese market. This is very much true, and is something we believe strongly in, along with our strategy in India, that there is a return for the work that we can do by bottom-up stock picking. Thirdly, the improvements we spoke about today, such as capital efficiency, cash flow allocation, valuation, and shareholder returns, these are fundamental structural changes in the market. These are not flashes in the pan. We believe strongly in the direction of travel over the long term for these investment principles. And as we mentioned today, the outlook from here we believe to be as exciting as it has been since launch of the strategy. CTJI was built around specifically these investment principles that we mentioned, and is as relevant, if not even more relevant than it was at launch. So we believe confidently that we are in the right place in Japan to benefit from the right kind of fundamental improvements. And I think it's worth reiterating, the Japanese market, as we showed you earlier, has performed very well in the last decade, and that has been in spite of major macro headwinds such as deflation, negative interest rates, yield curve control, persistent yen weakness, even net selling by foreign investors. And yet, the stock market, Japan corporates were able to give strong performance due to fundamental improvements. If we think about it today, the companies are in the best position they've been, but also many of these headwinds, we believe, are potentially turning to tailwinds as the macro environment improves, both in terms of inflation, positive interest rates and rising interest rates, a strengthening yen, and we hope more interest from foreign investors. So we think the Japanese market, the setup today, is as exciting as it has been. Thank you.